Welcome, everyone. Thank you for joining in today. Just a brief overview of what we're going to cover today. So the Coronavirus Aid, Relief, and Economic Securities, which is called also known as the CARES Act, that a lot of you might have been hearing about, was passed in the Congress on March 27th, 2020. It's over a $2 trillion economic relief package that is intended to protect the American people from public health and economic impacts of COVID-19. While the stimulus checks and the SBA loans of EIDL and PPP of the CARES Act have received a lot of attention, I think a very important provision of the CARES Act has been flying under the radar without much attention. So today we have our guest speaker, Damion Lupo, who is a powerhouse entrepreneur, leader, investor, as well as a retirement expert, who will talk in depth about the provisions of the CARES Act that will allow you to withdraw retirement dollars without penalties. So specifically, we'll cover how you can borrow up to $200,000 from your retirement accounts, skip all your loan payments on any retirement accounts until 2021, and pull out up to $100,000 from your retirement plan without penalty and not paying taxes until 2022. So let's dive in. A quick disclaimer before we go in there. All this is for educational purposes only. Please always consult your own attorney, your CPA, and your financial advisors for specific tax situations. Quick housekeeping rules. Please use the Q&A box for questions. I find it very hard to track the questions in the chat box. So if you can just locate the Q&A box in your Zoom application and use that for any questions. Yes, this webinar is always recorded, and I will send a link out to all participants and registered attendees within 24 hours. If you can whitelist my email, that saves me a lot of time because a lot of people have it going to the spam folder and then email me. Oops, what happened there? I'm sorry. Something happened on my end. So a few upcoming webinars that I wanted to just give you a quick alert on. We have a webinar on the tax implications of the CARES Act. So I'm focusing a lot on the CARES Act the last few weeks because this is something new to all of us. And as much as I wanted to understand that, I want to make sure that the knowledge of what's in the CARES Act and how it impacts you is out there for everyone to make use of. So we have our CPA, Ted Lanzaro. He'll be talking about the tax implications, and there are some really hidden tax benefits for you to take advantage of. One of them that I learned about yesterday, which blew my mind, was the ability to carry your losses from 2019 all the way up 5 years back. So if you had losses in 2019, you can now take it back against income the last 5 years. So that's really a powerful tool for us to use. So we'll be talking about that and then some more of things that will impact you from the CARES Act. We also have a college planning and savings webinar with Jeb White, who is a college admissions expert. And I haven't still decided who will be speaking here, but we have one on life insurance and this concept of infinite banking, about how you can create your own savings account using the concept of using life insurance as a tool. Last but not least, we have the tax and asset protection strategies with Toby Mathis of Anderson Legal. He'll be covering all the tax and asset protection strategies that you will have to put in place, whether you are a professional or you are an investor, whatever the case might be. So you want to make sure that you are protected, well protected, especially with everything that's going on right now. Besides that, we have ongoing webinars for kids. I teach kids 11 to 18 about financial education, basically financial literacy courses. And you can register at MoneyWise Teens there, that link. And my partner, Anar, she's covering the kids section, which ages 5 to 10. A lot of you know me already, so I'm just going to skim through this. I'm a real estate investor. I'm an ex-IT professional. I moved into real estate, now doing real estate brokerage as well as syndications. And I'm also a life insurance agent. So I was intrigued with this concept of infinite banking, and I got into that. I manage my own portfolio of rentals and also some multifamily investments. I'm passionate about investor education, and I run a group called Purely Passive Investor Group on Facebook. Today's guest speaker, Damion Lupo, he is an impressive personality. I was just reading his bio and I was like, oh my God, he does a lot. So he is a financial mentor, and he has his own podcast called Financial Underdogs, where he tears apart conventional wisdom for investors who are looking for truth about money and investing. He's also a 5th Dan black belt and has created his own martial art form called Yokido. He is a best-selling author, has written numerous books on personal finance, and he's rewritten the rules and plans for retirement. In addition to this, he also owns a company who has an investor retirement tool called eqrp. So his strategy gives individuals total control of their retirement money to invest in real assets like real estate, gold, crypto, and then some more. Last but not least, I was blown away with his mission of freeing 1 million people from financial bondage. So with that, I'm going to hand it over to Damion. Thank you, Damion.
Thanks, Kavitha.
Looking forward to this.
Yeah, appreciate it. Appreciate you guys all being here. It's we're going to dig into some stuff with the CARES Act and share with you guys some tools that you're going to be able to tap into. A lot of you have retirement accounts, and let's just make sure, Kavitha, is it beaming over to me as a panelist?
Yeah. Let's see. No, it's not. Let's do this. I need to stop sharing. So can you talk a little bit?
Yeah, I can definitely talk and see if it shifts over to me.
Let me see that.
Otherwise, you guys are going to hear a voice.
We can see you.
Okay, you guys can see me? All right, good. Okay, cool. All right, so we're going to, as Kavitha mentioned, and thanks a lot for having me, in front of you guys and being able to share this. It's always nice to have people that care about their financial future enough to spend some time in the evening and dig in. We're going to talk about the CARES Act, which was the big coronavirus reaction. The government legislators said, hey, let's spend a whole bunch of money. Part of that was spending money on allowing you to tap into your retirement accounts. So basically, to get to it right into it, there's 3 major pieces for retirement accounts that were part of the CARES Act. There was a piece on disbursements, there was a piece on loans, and then the RMD. So RMD was the easiest one. If you have an RMD because you're 72 or older, you don't have to take those out this year. You literally can just skip them. So no distributions required for RMDs in 2020. Now, this is where it gets interesting, because with the disbursements, it used to be that if you wanted to take money out and you weren't 59 and a half, you had to pay a 10% penalty. So, and then you had to pay taxes on whatever you took out. So like, let's say you took out 20 grand this year, then next year you'd have to pay taxes on the 20 grand. And if you were under 59 and a half, you'd have a 10% penalty. So it's kind of painful, which is why most people didn't pull money out. What they did is they changed the rules. So up between now and the end of the year, you can pull out $100,000 max, or up to all of your money, whichever's less, and you can take it out, no penalty. So if you've been impacted by coronavirus, you simply certify that you were impacted. It's a little form. If you have an eqrp, like a lot of real estate investors, you can simply certify to yourself. If you have a company plan, like you're working with you work for a big company like Kavitha used to, then they may or may not allow this to happen. They have to change their plan a little bit. So if you have an IRA, you can also do this. The $100,000 then is taken out, and you have 2 options. So either it can be kept and you pay taxes, or it can be returned as a rollover. So if you want to keep it and you don't want to pay it back, it's now in your pocket. You can do anything you want with it. If you're going to do that, you would pay taxes. We split up the 100,000 or whatever number you take out. We're going to split it into thirds. And basically 33,000 is going to be added to your income next year. And then you would pay taxes on that in 2022. And then in 2022, we'll add a third of it to your income, and you pay taxes in 2023 on that new income. So basically what happens is you don't have to pay taxes on anything for 2 years. And then you're only going to pay taxes on a third of that being added to your income in each of those years, which obviously you pay in the following year. So you pay your taxes on this distribution between 2022 and 2024. The other option is you can say, okay, I just want to give it back. I want to put it back in there. And normally you have 60 days if you do this. It's called a rollover, where you take the money out. You have 60 days to put it back in a plan. Well, here you have until the end of 2023. So if you take out 100,000 or any number right now up to 100,000, you can simply do nothing and put it back in by December 31st, 2023. That's a 3.5 year quote unquote kind of loan. No interest, no payments, no penalties, no nothing. So you've got two options, and that's the disbursement piece. This is eligible for any type of retirement account, self-directed IRAs, EQRPs, 401ks. If you've got a company plan where someplace where you work, again, they actually have to change their plan, add an amendment to the plan, and it allows you to do it. Some companies like Lululemon and Amazon they haven't done it so far as of a couple of days ago. So if you have a company plan, you'll have to check. An IRA is pretty simple. An EQRP is very simple. You literally just write yourself a check. So
hey, Damion,
yeah, go ahead.
when you do a return, does it have to go back to the same plan, or can it go to another retirement plan? Let's say I want to set up an EQRP and then put it there, or an IRA and put it there.
So what they did is they said it has to be rolled over instead of within 60 days. It has to be rolled over within 3.5 years. So they didn't give any guidance saying you can't do it. So at this point, our belief based on this is that it's a rollover, so it could go somewhere else. It could come out of your plan and get rolled over into an EQRP whenever you wanted to do that. So
because that would be a good way for people who are employed who previously couldn't access their money can now roll it over to a self-directed plan.
That's right. It's a great point. That's what the legislation, when you read the CARES Act, it literally says you have to roll it over and put it in, return it into your qualified plan within 3.5 years. So unless they change their mind and say it has to go back in the same plan, then you have the option to put it wherever you're going to want, as long as it's a qualified plan. So that definitely is a great tool to be able to get the money out of your employer plan and into the EQRP for sure. And if any questions come up, feel free to interrupt me. Okay. The other one is the loans. Now, loans used to be only available for some 401ks and all EQRPs, and it used to be $50,000. You could borrow $50,000 or up to 50% of your account. That is no longer the case. Between now and September of this year, you can borrow up to $100,000, and you can skip payments until 2021. So no pays in 2020. Once you start making payments a year from now, those payments are made over 5 years and you return it back. You get to choose the interest rate if you have an EQRP. If you have a company plan and they allow a loan, it's going to be whatever rate they tell you it's going to be. So now the other thing is, if you already have a loan out because you took one out from your 401k or your EQRP, no payments in 2020. You just skip them. There's you don't have to make them. So basically, this gives you the ability to borrow $100,000 from this section and pay it back over 6 years with no payments for the first year. So you pay it back in quarterly payments between 2021 and 2025. So between the two of these things, you've now got options for up to $200,000 that you could potentially take out and put back in and not have any taxable events. I'm going to show you how to actually do this, take money out and not pay taxes on it at all. And so I think you guys are going to like that. Kind of a cool strategy that's only available for about 3 or 4 more years, because some tax law changes happened with the Secure Act last year. And that gave us some options with real estate that are really, really cool. So we're going to go into that. But before we go into that, I want to see if you guys have any questions about this specifically, the disbursements or the loans. Loans do not apply to IRAs. They only apply to 401ks and EQRPs. And you have to have the loan provision in your company's 401k. It's always going to be in an EQRP. Disbursements apply to everything. So you could take, and it's a maximum of $100,000 pulled out. It's a maximum of $100,000 loan. Even if you had like 5 different 401ks, a bunch of different retirement accounts, it's an aggregate amongst all the different retirement accounts. Keith, any questions come up?
Yes, some questions have come in. So a few folks asked, what qualifies me to take out 100K? What are the government qualifications for me being affected by COVID? You said, you have to be impacted by COVID. What defines an impact?
So what the government has said is there's a form and it's for between you and the trustee of the plan, the administrator of the plan. So if you have an eqrp, it's you. The form says I've been impacted adversely by the coronavirus, and therefore I qualify. It's literally that simple. You just have to say that you have, and it's really hard to not have been impacted in some way or another. So if you've been impacted, you just certify it, and that's all the administrator of the plan needs is just the participant, which is you, certifying that you were impacted, and that's it. There's no other.
Almost everybody's impacted, right? In this case,
everybody's impacted. I mean, it's
right.
it's unrealistic to think that we're not. I mean, even if you could say, hey, now I have to watch 7 hours of CNN every day. Hey, that's a pretty big impact. I don't know. But there's an impact.
Okay. So another question, I have a question. I think this is what I asked already. With CARES Act, we will be able to take out the money from a current 401k and move it in 3 years to a self-directed retirement account, or do we have to return it to the same 401k?
What they did is they looked at the legislation, just expanded the time period for a rollover. It used to be 60 days, and then you'd have to put it back in. And they said you just have to return it by the end of 2023. So that when you do a rollover, if you pull money out of any retirement account and you have 60 days, you can put it into any other retirement account generally, like a 401k to an IRA to an eqrp, 401k to an eqrp. And all they did was expand the time frames for returning it. So the rollover now is 3.5 years.
So this is an interesting question. I think the answer is both the husband and wife can take it, but I'll let you answer. The 100K distribution is per person. A husband and wife who have a QRP can take a 200K maximum distribution.
Yeah. So if you it's per person. So absolutely. If there's a husband and wife, and so each person has an allocation that it's their money. So it's allocated. So if you had $400,000 in your plan, a couple $100,000 each, you could technically easily take up to 400,000 out.
Right. So basically 100K in disbursement, 100K as a loan for each person.
Yeah. And
a total of 400K.
Yeah. And remember, this is an official loan, and this kind of looks like a loan if it's a rollover for 3.5 years. It's just an interest-free loan with no payments.
If I take out 100K from my 401K, but then in a few months later, I get laid off, what is the ruling in that case?
If you took out 100,000, same rules. You just have to either pay it back put it back into a plan by 2023, or you can say, okay, a third of it's going to be taken. I'm going to keep it and pay taxes on a third of it in 21, 22, and 23. So it doesn't
being laid off doesn't impact that in any way. So essentially, it actually makes your 401k yours, because now you can roll it over into something else, right?
Yeah, the whole thing would then be eligible to roll over. You can move it into an eqrp. At that point, you have control of everything.
Right. Do all of the UBIT taxes apply on profits from the disbursement loans from existing 401ks or SDIRAs?
Do all of the UBIT taxes
apply on profits? Oh, I think what she's saying is, so let's say I take a disbursement or loan from an existing 401k, and now I go invest it. So, and I make profits. So UBIT taxes apply there, or is it just considered your cash?
When you take money out as a loan or a disbursement, that money is now in your hands. It has nothing to do with your retirement account. You personally owe that money back if it's a loan. And if you did a disbursement, you wouldn't owe it back unless you wanted to. So at that point, UBIT's not applicable, because UBIT only applies if a retirement account owns an asset. At this point, the money's in your hands, so you'd own it, or your LLC would own it, but your retirement account would no longer. So therefore, it's a.
But you'll get personally taxed on the whatever profits you make, right? Because it's just like personal taxes. Yeah.
Yeah, it's the same. I mean, that money's going to be in your personal account, so that it's not being sheltered anymore. If you want it to be sheltered, then you would need to keep it inside one of the plans.
Makes sense. I could pull it out of my 401k and then move it to a self-directed IRA right away, then use it for real estate investment. I don't think you will have to move it into self-directed IRA, right?
So no, if you're pulling it out, you can then roll it over to wherever you want it in terms of a retirement account. But we'll go into it in a second why you would never want to roll it into a self-directed IRA and invest in real estate, because you're going to get hit with UBIT tax, and the EQRP exempts you from that. So You wouldn't want to do that, but you could do it if you wanted to, if you were doing something, if you were buying maybe a house with no debt, but that's pretty unlikely. Most people have debt involved in their real estate deals.
Right. I have a lot of questions. Do you want me to keep going?
Yeah, fire away.
Okay. Can we decide if we want to return or pay taxes for the third later?
Yeah, you don't have to decide until, so the first time you'd have to pay taxes if you pull money out is April of 2022, because remember, a third of this 100,000, whatever number, a third of that money, the disbursement, it goes onto your income for 2021. Income in 2021, you don't pay taxes until April 2022. So that's the first time you'd have to decide is 2 years from now. So you can just kind of play it by ear and decide later. There's no requirement to decide now.
So there's nothing we have to make a decision on right now. You could just take the money out and decide whatever strategy works best at that time.
Yeah, there's really no downside. I mean, the one downside, if you think the stock market is a good place to be, which I have no idea why you would think that, but if that was the case, then you might think, oh, I don't want to miss out. But there's no downside to you pulling it out and having it sitting there, because you could put it right back in, or you could do something else with it if you found a deal you wanted to personally invest in.
Would this disbursement apply to an inherited IRA?
It applies to all the plans that we've seen. I don't know if there's a specific mention in the CARES Act to an inherited IRA, but actually, so inherited IRA is actually, okay, now that I'm thinking about that, an inherited IRA, there's no penalty because you can just pull the money out anyway. So the only question would be, if you pulled out 100,000, could you then split it amongst the 3 years? I don't remember if there's a specific provision. We'd have to look at the CARES Act again and see if I doubt it, but sometimes they just miss things. They don't put in something like that. And so we just wait for guidance from the IRS. So at this point, I don't remember seeing anything about inherited IRAs specifically.
Got it. All right. Arun asks, you talk about 100K being interest-free till December 2023, but wouldn't one pay taxes until in 2022 and 23, or is there an election to avoid taxes?
So you can either keep it, which is when you pay taxes, so you're never giving it back, or you can give it back by 2023. So if you're giving it back, then it's not a disbursement. It's literally going to turn into a rollover. So you get that option. So if you're putting it back, there is no taxable event. If you decide to keep it, you would have to pay taxes in 22, 23, and 24.
So you will have to make an option to decide whether you're going to return it or keep it right in the beginning when you take it out.
In April of 2024, or sorry, April 2022. So April 2022.
When the taxes are due.
Yeah, if you're gonna keep it and pay taxes, that's when you need to start making. You have to decide, okay, I'm going to add this to my income. Because if you're not adding it to your income, it's not. If you're just going to return it by 2023, there is no, like, you're not doing anything with it. It's not being added to your income in 2021.
So basically, by not paying taxes for it in 2022, you are essentially deciding to return it. Is that a fair answer? Okay.
Yeah.
All right. Lots of questions. I just keep going. If you take a 100K distribution in 2020, is the QRP supposed to give out 1099 forms?
If you have it, my guess is we don't have any specific forms yet that we've been given, but I'm guessing there's going to be some type of form that identifies it as a disbursement. So we don't have them yet. Likely they'll tell us what to use. So you'd have a 1099-R that would be a disbursement. There'll probably be something specific to this unique piece of legislation. We don't have anything yet.
Okay. Vilva asks, how does it apply to regular IT employees who also have a side business? Who can certify or qualify us?
For which part?
I'm not sure. I think what he's asking is maybe who can certify or qualify us, whether we are eligible for these loans and disbursements. I think
it depends on
the plan.
Yeah, it depends on which plan. So if you're working, if you have a plan with a company that you're not in control of, then you would certify that you're eligible if they allow it. If it's a private, it's like an IRA or an eqrp. If it's something that you control, self-directed type of plan, that's you to certify it. You just certify it to yourself.
So the answer is depending on the plan, whether it's employer or your own plan, you decide.
That's right.
Can the eqrp be set up freshly right now, or should it have already been set up?
It can be set up right now if you want to. There's no limit like when we had the Small Business Administration that you're probably going to have people talk about, the loans and different payment, the PPP program, those things you had to have certain things in place already. But this doesn't matter. You could set up an eqrp today and start using it for this process. And some of the things I'm going to show you how to do to get money out and never pay taxes ever.
Okay, as I'm answering, more questions are coming in. So if you want to get to what you want to talk about, that's fine too. We can ask the questions later, whichever way you want to run with it.
Oh, we're good. Just keep them coming. Okay.
Are the rules different if it's Roth IRA?
No, it's any disbursement. It's the same thing. The weird part about Roth IRAs is the basis. So with a Roth IRA, you've got two pieces in the Roth IRA. You've got the basis, and then you've got your gains. So the basis is the amount of money you put in. That you can take out anytime, no penalty, and no tax. So like, let's say you had $60,000, and basis is how much money you put in, or maybe you rolled it over from a Roth 401k into a Roth IRA. So we're talking about Roth here. If you had 60,000 in basis and you had 40,000 in gains, the 60,000 you could take out, and it's just you get to take it out. Like there's no taxes or penalties. The other 40,000 is the disbursement where you're going to end up, if you're under 59 and a half, you're going to have a taxable event on that, just like any other retirement account disbursement. And then you'd have the ability to make those payments on over 3 years, or you could put it back. So you have those options either way.
Is it supposed to be tax-free in a Roth, like all the gains are not supposed to be taxed?
Yeah, it is if you're 59 and a half.
Okay.
Yeah, but if you're under 59 and a half, because if 59 and a half, this doesn't really matter because you can just take it out anytime you want, tax-free, penalty-free. It doesn't make any difference. It's really just the gains if you're under 59 and a half. Got
it. But the basis can still be pulled out.
Basis can be pulled out anytime you want.
Got it. All right. Are IRA and 401k providers required to post these rules and forms on the websites? I checked with Vanguard where my 401k is equipped, and I did not see any CARES specific instruction. Loan limits are usually 50k or 50%, whichever is less.
Right. So the loan, if your plan has a loan, then the loan changed. They don't have to allow the disbursement, because what happens if it's a 401k for your work, the plan administrator has to actually change the plan to include this. So it's not mandatory. It's something that they have to change. And if they say they're not going to put it in there, the other thing is if they don't have a loan provision, you're not going to have access to that either. So it's up to them. It's always up to the administrator, the way that they write the documents. EQRPs always have both disbursements. I mean, it's an automatic thing. So it has everything, but your company, you have to ask the administrator if you have the disbursement. Is there a requirement for them to put it on? Not that I've seen. No.
Yeah, unless your Vanguard account is held by yourself, like you holding it, and it's not a company account, then you could roll it over and get access to it.
That's right.
This distribution of 33K per year for 3 years is looked as ordinary income. Is that right?
Yes.
Yes. Is it 100K per person or per account?
Per person. It's aggregate. So if you have a bunch of different accounts, IRAs and 401ks, it's a total of 100,000 as a disbursement. And then amongst all of your eligible accounts, you could take up to $100,000 as a loan.
So he has both an IRA and a 401k. Technically, he could do a disbursement and a loan from different accounts, right?
Yeah, absolutely.
Up to 200K. Mm-hmm. Okay. So Nikolai, the answer is yes, you can get up to 200K if you have, let's say 100K in your IRA and another 100K in your 401k. But you cannot take a loan against your IRA. Is that right?
That's right. An IRA is only eligible for the disbursement. Yeah.
Okay, we're coming to the end. The end is in sight. What else? Okay, what do you think the long-term effects of the mass amount of retirement funds getting pulled out of the market will be?
Honestly, I think that a lot of people are going to end up with a lot less money down the road because they're going to spend the money just to survive right now. But, that's really, it's a personal thing. Unfortunately, there are unintended consequences. It's kind of like in the 90s when Congress had a balanced budget. everybody thinks, oh, Congress did good and Clinton did good. And what actually happened is the Roth was created by William Roth, the senator in Delaware. When the Roth was created, a lot of people moved their money from traditional over to Roth. And so they paid taxes on that money then. And so 30 years down the road, normally they'd be paying taxes on a whole bunch more money. But what happened is they paid taxes then, and then they never have to pay them again. That was a whole bunch of extra tax revenue that Congress knew would come in. So it looked like they were super smart. Unintended consequences, Congress is not going to have that revenue coming in 2020s and 2030s that should have been there. But Roth was a huge giveaway. So there will be unintended consequences here too, I'm sure.
Okay. I think we've gotten through all the questions. If you want to talk about whatever you have next.
Sure. All right. And if you guys have specific eqrp questions, I know some of you know about it, and we can give you the highlights on that too. What I want to share with you guys is a way. So let's say you have 200,000 that you are going to move into your eqrp from a disbursement, a rollover, whatever it happens to be. You leave a job or you just move it in there. I'm going to show you how to get this money out of your retirement accounts and into your personal accounts tax-free and be able to do some pretty neat stuff. So let's say you have 200,000 and you put it into your eqrp. This is like in your 401, okay, or an IRA. So the 200,000 goes in your eqrp. And then you take that and you do, it's called an in-plan rollover. We move it into the Roth eqrp. When you convert traditional money, which is pre-tax, to Roth, that's what that does is it adds 200,000 to your ordinary income. So ordinarily this sounds terrible. Here's how you get out of paying taxes at all. If you were to say buy a piece of property for, I don't know, 800,000, you're going to be able to use bonus depreciation and have at least a $200,000 loss from the depreciation. That 200,000 can offset the 200 that you added to your income from the conversion if you're a real estate professional or your spouse is a real estate professional. So this was part of the Secure Act that was passed, and the part of the act 2 years ago when we had all the real estate things that were thrown in there with bonus depreciation. Basically, if you or your spouse are a real estate professional, now that the money is in your Roth eqrp, so this offset each other, and you go, well, wait, how am I supposed to get $200,000 if I don't have it waiting? You could actually pull the money out of your eqrp, your Roth, tax-free and penalty-free, tax and penalty-free, because now it's considered basis. So you have the ability to get your money out and buy real estate. And now, since that is going to be your personal real estate, all this cash flow is going to you directly. This is a way, and this is only available until 2024, 25, because there's a sunset provision in the legislation. If you want to start tapping into your retirement assets in a very smart way, this may be a really, really effective way to move it through an eqrp into a Roth. You might want to keep it in the Roth, but when you move it over, it becomes basis, so you can pull it all out tax-free and penalty-free right after you do that. So this is a very powerful strategy to get money out of your retirement account and into your own account, so you can start getting the cash flow today. Any questions on that?
Sorry, I'm muted. I've been talking. I'm muted. So there are some questions here. So let's say someone is a passive investor with passive losses via K1s right now. Can they do this and not have to actually go out and buy a property to get the depreciation? I assume yes. I don't see why not.
Which part? That's the
fact that they can use other passive losses from investing, as long as it's like 200K or whatever amount, and they're a real estate professional for tax purposes, they can offset that 200K in income for this year.
Yeah. If you're a real estate professional, you don't need to go buy something. If you just had a bunch of losses, it's up to 500,000 per year that you could offset. So you could convert up to 500,000 this year and 500,000 next year and use passive losses if you're a real estate professional to offset those. So yeah, you don't have to go buy anything new.
Okay. Um, I have withdrawn for 100K from solo 401K last year. Is there a way I can return it and now use the CARES provision to save penalty and taxes?
Unfortunately
The
not. That's
smiley face.
no, I'm the bearer of bad news. You can't do anything that you did from before. If it was more than 60 days ago, then you're kind of out of luck. And obviously it's more than 60 days because 2019 was about 120 days ago. So yeah, unfortunately you're not able to put it back in. However, if you have any type of income that's 1099 income or something, you could recontribute it. But that's going to be, that contribution is going to be a deduction for your taxes. So if that money's still around, you could potentially contribute it if you have any other income that's outside of a W-2.
Okay. If I have bonus depreciation of 100K in 2022, can I choose to include all 100K in tax so I can apply all 100K depreciation in 2022 instead of the third in each year?
Well, if you have too much loss, like if you've got that loss and it overrides, it's going to be carried forward. So like, let's see if we can figure out. So you're basically saying if you've got losses of say 100,000
He has a bonus depreciation of 100K in 2022.
bonus depreciation.
Right. So, and he's asking if I can choose to include all 100K in tax so I can apply the 100K depreciation. So basically, instead of paying back or doing the one third on the disbursement, he's asking if he can just apply that 100K, as long as he's created a loss, he can apply that in 2022.
Yeah. So what's going to happen is either you're going to have that $100,000 loss going against up to 100,000, or it's going to be carried forward. So it may be that you have other losses or other gains that it will impact. We don't have guidance on whether you can do it all at once, but just keep in mind, you're not going to lose it. It's going to apply. So this is not working against you. If you have the income and it's only 33,000, you may as well, if there's, I don't know if, the IRS could say anything they want to and give guidance because Congress jammed this thing through really fast, but that loss is just going to pass forward. It's going to carry forward. So you'll be able to use it eventually, even if you can't use it all that year.
Okay, I have a lot of questions, so we'll go through it.
Sure.
What is an eqrp? And there's also another question which is related, which is what is the difference between a solo 401k and QRP?
Sure. So a solo 401k is really just a generic term for a 401k that a person has and has limits on what it can do and what kind of protections it has. Basically, so that you guys all know, there's 401k type of plans, and then there's IRAs, and these are 408 section of the code, and these are under 401. So in 401, there's all sorts of different plans. There's a solo type of 401k where an individual has it. There's an EQRP. There's lots of different pension plans. And with the solo plan, basically what they were set up to do, they're a generic plan, and you have the ability to do investments because you're in control of it. So you're the trustee, and they can work for certain things. The biggest differences between say solo, and which a lot of companies do these, and an EQRP is a solo cannot have any type of employees, even part-time employees. Doesn't work. So no employees, even part-time. An EQRP can have part-time employees, full-time employees at any point. So here's one of the problems that we're seeing people have. They have a solo 401k, they invested in some real estate. Both of these are exempt from UBIT. So UBIT is that big nasty tax. So that's great, they're exempt. The problem is if you have a solo and you've invested and it's not an EQRP and you're in a real estate deal, and then a year later you decide to hire a part-time person because your business is growing, you literally have to get rid of the solo, turn it into an IRA. Now you're subject to UBIT. So you're forced to literally dissolve that or just give it up, and then you have distributions. So huge problem with employees. And the other one is liability. So all this stuff all of these plans were designed originally back in the early 70s under ERISA. And ERISA created things and it said, we're going to have these plans, and if you get sued, you can't be touched, you can't touch the money, and it's going to be very protected. And that worked. That was great as long as you were with a company plan that had employees. When you have an individual solo 401k and you don't have, and you're by yourself and you get sued, because it doesn't matter if you're a passive investor, if you get sued because you run over somebody's dog or they trip over your curb and you lose, they're going to come after your assets. Solo 401k assets are not protected the way ERISA protects company plan assets. So you could literally have a big pile of $1 million, $2 million, and you get sued and you lose because of some dummy that saw a bus moving by with injury attorney, and you lose your money there. The EQRP has asset protections, so that money can't be lost. It can't be taken. There are barriers because of the way it's built. It's totally different. So here we have liability protection. Here we do not. Those are the two biggest differences. Every plan, every retirement plan is written differently, whether it's a 401k, an EQRP, a 457, they all have different provisions. The EQRP has the most amount of options. It doesn't limit anything. I've seen some plans that actually do limit things. So total control of your money, total options, you can have employees, and you've got liability protection. And it's simply because they're built differently.
That's great to understand. Thank you. Okay. More questions. What if we have, this is an interesting one, and I think the answer is yes, but I'll let you answer. What if we have a deal under contract as a real estate professional? Can we use this to purchase that deal? This would be from a solo 401k, because normally I think your retirement accounts couldn't be used for your own deals, right?
Right. So if you want to use your retirement money for your own deals, this is a perfect place to take a disbursement. So you can actually pull money and now you can use it for your deal. That's how you would do it. Because if you're running your deal and you want to run it and you want to put your money into it, that looks like an active business, and that's not allowed inside of a plan. Retirement assets are meant to be in passive investments. And so if you wanted to put that money in there, it would look like a disbursement.
Right. And they, being an RE professional, they could also make use of that depreciation from that asset and actually pay maybe nothing in taxes if they work it out right.
That's right. Like there's a lot of options. With a real estate professional and things, there's a lot of options. There's also something that's important for you guys to know, because some of you probably have some type of investment already in, whether it's a house or it's a duplex or something, and it's in an IRA and you've already invested it. And so this is going to lead to UBIT. Now, if you don't know what UBIT is the unrelated business income tax. It's a tax at 37% on almost all of whatever income we're talking about, 37%. It gets triggered because you've got an investment that has some type of debt. So in a syndication, there's usually like 70% debt. So I'm going to give you an example of how this is going to hit you and how to get out of it. So let's say that there's a property and you put $50,000 into it out of your IRA and it doubled. That happens a lot with deals over say 5 or 6 years. And now it's at 100 and there's 70% debt. This is very common. It's a very common type of deal. So in this case, let's say your IRA invested in this, you've got $50,000 of gains. 70% of the $50,000 in gains is subject to UBIT. So 35,000 in gains is subject to this, and it's going to be close to 37% of this. So up to $12,000 in tax. That's the bad news. The good news is we can move this asset to an EQRP before the asset sells and be totally fine, and it's exempt. No tax. Now, some of you are like, well, I already have an investment and I've never been charged UBIT. It's because the UBIT is charged on the net income. And when you have depreciation, you're going to see your K1 with a negative number. So you're not going to have it hit you. So this only is going to happen. It's the net. And so this is really important when an asset sells. It typically doesn't hit very often when it's actually, being the process between 0 and 5 years or whenever it sells. Here's the problem for waiting. If you say, okay, well, I'm going to do this later, Congress is always looking for new things to spend money on. And when they do, they have to find other things to take from. So they can't just spend there's the way that the rules work is it's pay go. Basically, that means if we're going to spend 10 billion, we have to cut it somewhere else. This ability to move assets from an IRA in here eliminates UBIT. UBIT is something that they like because it creates more tax revenue. There's a high likelihood that Congress will eliminate the ability to move money from an IRA into an EQRP. And so if they do that before you move your assets, you're stuck because you're going to be subject to UBIT. So it's just something to keep in mind. If you have an IRA with any type of real estate that would be subject to UBIT on a sale, the time to do it is now while you still can. It's not something you want to wait until like right before the asset sells, because you may not even have the option. It's highly likely they're going to kill this option.
Yeah, and I know a lot of people who use SDIRAs to invest, so this is something you do want to take note of. And a related question here. So do we have UBIT taxes if self-directed funds are used to buy membership share in LLC? Depends on what the self-directed account is, right?
Yeah, so there's a common misconception that if you invest in shares, then hey, you haven't taken out debt. But here's the way the IRS looks at it. If your investment is gaining because of debt, doesn't have to be your debt, it's because of debt, then you're going to pay this tax on anything proportional to the debt. So that LLC has debt, and because of that, you're subject to UBIT. There's just no getting away.
Yes, even if you invest in an LLC, if it's from an IRA, then you're subject to UBIT. If it's from a 401k or a EQRP, then it's not.
That's correct.
Okay, more questions. Please explain why the 200k would have to be converted to Roth EQRP. Not sure I'm understanding that reasoning.
All right, let's find the slide over there. Let's find the. So to be able to control it, so if it's in your 401k, for example, you may not have the option to convert it to a Roth. Once you move it into an EQRP, it's up to you. You can move it to a Roth. That's why you move it into an EQRP first. There's no income limitations. There's no structural limitations. A lot of 401ks just don't let you do certain things. An EQRP gives you the flexibility to convert whenever you want to. It's really just because an EQRP is written to give you all the options versus a 401k is meant to kind of shackle you a little bit.
So I think he's asking why it needs to be a Roth. I think that he's not getting the point of why it needs to become a Roth.
Because if it's not a Roth and you pull it out, you can offset the taxes, but you have a 10% penalty.
But right now there's no penalty though, right?
Up to 100,000. So you could have 500,000 in here. And if you pulled it straight out, or if you pulled it out of your 401k, you're gonna have a 10% penalty on everything over 100,000. So if you move it into an EQRP and you convert it to Roth, you can convert up to, well, anything you want. You can convert it, and now you can pull it all out because it's basis, and that eliminates that 10% penalty.
So I think what Damion is saying is you can do the conversion and not pay the penalty by using depreciation, essentially, right?
Well, yeah.
Whatever that amount is that you convert to a Roth. So essentially you're doing pre-tax dollars to post-tax dollars, and then actually not paying tax with the depreciation that you get.
Yeah, the depreciation is going to offset the actual taxable stuff. What you're doing when you convert it is you're eliminating that penalty. So right. This offsets the tax. This conversion offsets the 10%.
Right. Okay. So another question here. My 401k is with my employer. Will I be able to take a disbursement? I guess depends on the employer, right?
Depends on the employer. Yeah, you just have to ask the administrator and see if they're updating their plan with the new rules.
Right. And if there's a hardship situation or whatever, how they're affected by COVID, they might be okay with that.
And it's not, there's not a hard and fast rule that you have to have a certain thing happen. You simply have to say, I've been adversely impacted because of the coronavirus. So it's very straightforward. It's the same. A lot of times people say, well, I don't know. I don't think I qualify for an EQRP or anything.
Yeah, actually, we got that question. How do I qualify for EQRP? I'm employed.
Perfect. So who can do it? So who? Anyone with any type of business. Okay, so what does this include? You can be a W-2 employee, you just have to have a business. You can have 10 different 401ks, IRAs. There's no limit on how many you can have. So what counts? You have a lemonade stand? You have an eBay store. You have an online affiliate.
Qualify with a lemonade stand?
What's that?
Can a kid qualify with a lemonade stand?
100%. I'm going to show you guys how to reduce your taxes with lemonade stands and kids in a second. So anything you have, if you do consulting, and there's nothing that says you have to have a certain amount of income. So you can have a lemonade stand and have nobody buy your lemonade. If you're at home right now and you go, I want to qualify, go put up a box, put some lemonade out there. And if nobody buys it, you still have a lemonade stand. It's still a business. So you're good. You literally are qualified. Qualified, eBay store. How hard is that? 15 minutes, you're in business. Consultant. So it doesn't take that much. The misconception is that you have to go out there and you have to have a profit. You have to have income. You literally have to have a business. And that business can simply be you saying, okay, I'm in business. That would just be Schedule C income.
If your business isn't making money, you can do the rollover from another plan that is making money.
100%. There's no rule excluding that, what you just said. You can have a business that's not making money and roll over your plan into an eqrp. It's totally an option.
So
Eligibility.
is a lemonade stand an essential business? Probably not right now, but I'm sure you can figure out an essential business. Online businesses are allowed, right?
Yeah,
all online businesses are open and running. So
they're all open. They're not being shut down.
I mean, look at Amazon, it's booming.
It's a good point. And an online business is absolutely eligible. Digital marketing for information is abundant, and that's simple, and there's no moving parts. So the answer is, if you want it, you can have one. It's not something that you're restricted to. A lot of times people are confused because the tax code's complex. This has been my expertise and focus for the last decade. So I know this like the back of my hand. And unfortunately, Google does not. Google has everybody's opinion. I'm going to show you guys.
Sorry, there's some funny things coming up here. So investments in stocks, is that a qualified business? I don't think so.
Talk to your CPA, because investing in stocks makes you a trader, and it's like flipping houses. It can be a business. You just have to look at it. Depends on your accountant, because different accountants will tell you different things. So definitely check into that. I don't know.
Sorry, I have to say, well, what people are typing, water is essential. So I have a water stand. Sell toilet paper.
Absolutely.
Sell PPE, protective equipment. Sell, I don't know, like gloves. I don't know, whatever.
Yeah, a lot of options.
N95 masks. So, okay, jokes aside.
All right.
I'm renting out a unit. Does this qualify as a business for eqrp? If you're
property managing, yeah, absolutely. If you're property managing, simply pay yourself. Pay the company that owns it can pay you, and so it's going to show up as 1099 income. If it's not 1099, if it's all going to your Schedule E, you don't have any income. So it's called recharacterizing the income. Normally, it doesn't make sense, because you say, well, if I'm going to have Schedule C, then I'm going to pay Social Security taxes. Well, you know what? If you charge $100 a month as a property manager and that goes on your Schedule C, you now have income as an active business. And so you can not only contribute that, but you definitely are eligible.
I think the key is you have to have an active income business. It cannot be a passive income business.
That's right. It's got to be active. So squeeze some lemons, put up a sign, it's an active business. So.
Okay, I have some more questions. Do you want to go to the kids thing before?
No, let's do these questions, and then we'll show you how to.
My spouse and I have a business and a solo 401k. We took 100k distribution already. My spouse has an old 401k from an employer 6 years ago. Can we roll over the 100k from 401k to solo 401k and take another 100k distribution?
Yeah, you could.
Okay. This is answered. I think there's a follow-up. If I intend to put back 100k distribution from a solo 401k in 2023, is there anything in terms of tax filing during 21, 22, or 23 I need to specify the intent to put back and not pay taxes?
Not that we've been told yet. If that changes, it'll come out, and we would share that with our clients. But there's nothing no guidelines or forms. It's far away, so I don't think they're putting any energy in that right now on forms that might be needed in 2022 or 2021.
Got it. So Amy says she wants to open an eqrp. Who handles those? Damion does. So we will share Damion's contact information after this.
Yeah.
Can you explain the EQRP structure? Do we have an LLC inside? How is it protected?
Yeah, there is. There's an LLC inside that we set up in Wyoming. So you've got that layer of protection, and then it's built. The trust foundation that it's built on is our unique architecture. It's our IRS approved prototype plan, and then we embed the LLC inside of it. So you've got liability protection, anonymity. It's not public record on who owns it. So there's all these different pieces that make it very unique.
Marinelle, I'm not sure what your question is. Can you please clarify if the property was held longer and got paid off, does UBIT still apply in your example when the property sold? Do you understand what she's asking? Lost your audio. Hang in there, folks. Hang in there for a minute. All right, let's see if I can answer some of these questions. I don't know what you're asking there, so I'll let Damion handle that. Hemant, what kind of share in an active business are you talking about? I don't think you pay UBIT taxes on purchases. You only pay UBIT when you sell, and if your investment is leveraged in any way, so whatever kind of investment it is, a business or otherwise, if it is leveraged, then you pay UBIT on the leverage portion of that gain. Amy asked, just to be clear, we cannot change from a solo 401k to a EQRP without a tax hit, correct? No, you can. You definitely can. It's the same kind of account, so you just roll it over. So you won't have a tax hit rolling over from a solo to a EQRP. It's a similar kind of account. The only tax hit will come if you move it from a EQRP to a Roth EQRP. So any regular account to a Roth account will get a tax hit, but not otherwise. Fees associated with EQRP, I'll let Damion handle that. Does being an LP in a syndication qualify me as a business owner? No, it does not. Definitely does not. It needs to be an active income business, as we discussed. It cannot be a passive income business. So if you are an LP, you're a passive investor. So you're not actively working in the deal. So it does not qualify you as a business owner. So anything which is active income, so let's say you set up an online store, like Damion mentioned, an Etsy store or Amazon store or an eBay store, that means that you're actively working for that income. So that is an active income business. So you cannot set up a QRP or a solo 401k based on a passive income business. I think we already answered this. Doing stock and brokerage accounts, not really sure, probably a CPA question. I'm going to say no, but your CPA can. So let's say you are a trader by, I don't know, that's what you do? You trade for yourself and you trade for others. Maybe you can. So might want to check that with your CPA, MJ.
All right. Can you hear me, Kavitha?
Yes.
All right, good.
All right. I went through some of the questions which I thought that I could handle. So I'll leave the tough ones for you.
All right. So why don't you hit me with the ones that you didn't, I did hear one of the ones you said about converting from a solo into an EQRP. There's no tax consequences with a rollover. It's only when you move it to a Roth. So
correct. Yeah. Can my kids be employees for solo 401k?
Kids. It's a great question.
Solo 401k, no employees, right?
Yeah. So if you're going to have, so basically what you have is your kids are going to have their own plan. And so if your kids have any type of income, they have like 1099 income, they can contribute. So what I'm going to suggest, if you have a business, if you pay your kids $12,200 this year, that $12,200 you pay them and they get a 1099. That 1099 income can now go into their EQRP. You get a $12,200 tax deduction from your business for them doing bona fide legitimate work. And that first $12,200, if they're under 18, not only is there not any federal tax, there's no Social Security tax at all either. So it's literally shifting income from you where it would be taxed with all sorts of stuff to zero. Once they have it, because it's active income, it can go into an EQRP. It can also go into a Roth EQRP. Why is that important? Because if it's Roth, you can take it out anytime. So let's say you have kids that are 6, 8, 10 years old, and you start putting $12,200, give it to them, it goes into their Roth, and 10 years goes by, you've got $120,000 in there. That can be pulled out for anything you wanted because it's basis. Contributions into a Roth are always able to be pulled out at any point, tax-free, penalty-free, and you got the deduction. So this money, not only did you get a deduction on it, it's now going into a plan where it can grow tax-free, and it can also be pulled out anytime. So it's a great tool to utilize, and all you're doing is shifting income. But there's no age restriction on when you can have an EQRP, an individual type of plan. This is something that's a really cool strategy if you have any type of income that you want to push and not have taxes on.
So there's a few more questions on this. Actually, I'm going to ask a question because I have the situation right now. So I paid my daughter $12,000 for 2019, and I issued her 1099. But I was told that she actually needs to file 1041 and pay self-employment taxes on that $12,000, which would kill the deal somehow. So I just wanted to clarify that.
How old is she?
She's 15.
So the tax code, and this is based on the guidance at Provision, which is one of the top tax accounting strategists and firms in the country. Tom Wheelwright's part of this firm.
Yeah.
So the guidance there is that if the first 12,200, and this is from the IRS site, we did a brainstorm session around this. The first 12,200, if you're under 18, is not subject to Social Security taxes. So.
And even if they're self-employed, like you issue a 1099, or is there an advantage in doing a 1099 versus putting them on your payroll?
If they're on your payroll, the problem is you've got to have a plan for your company. And so then you're changing the nature of your plan. So if you want to keep it very simple, I always like simple if possible. I only like complex if necessary. So we have an isolated plan for them for their whatever work they're doing, if they're doing consulting or whatever else. And we simply pay their work $12,200.
Got it. How old do my kids have to be paid to get paid $12,200?
It has to be some type of work. One of the things, I have a picture that I show when I was like 4 or 5 years old. I was a JCPenney model, and child models get paid pretty well, even at JCPenney, believe it or not. It's probably why they're bankrupt, because they paid too much money for models. But you can pay your kids regardless if they're 2 years old. Just use it for advertising for your business. There's a lot of ways to do things once they get older. They can take out the trash. They can do. A lot of kids know computers better than the parents. Have them do social media. It's easy to pay somebody $1,000 a month for technical stuff. So you could pay and say, okay, I want you to post these tweets for me, or that type of thing. There's a lot of different options. They just have to do something, and it has to be able to pass the smell test. If you say, take out the trash, I'm going to pay you $1,000 a month, good luck with an audit. Get your accountant involved and make sure that they're giving you a thumbs up on whatever you do, but you can definitely pay them.
So yeah, reasonable income for the role. Okay. When someone asks somewhere in the tax, where in the tax code is EQRP, what section of the tax code do you refer them to?
401. EQRP is the Enhanced Qualified Retirement Plan. All the qualified plans are in 401, and then you have the IRAs in 408. So the way that it's kind of, so the EQRP is a specifically designed retirement plan, just like a solo 401k it's a specific type of design plan. So it's how they're built. They're names for how they're built. They're different, but they're under the same code, the 401 section.
Okay. So Hemant asked, this is a confusing question. So maybe you can decode this. Please confirm that there are no UBIT taxes on purchasing share in an active business.
In a what?
On purchasing shares in an active business.
Yeah, there definitely can. Yeah, UBIT. It depends on whether it's a corporation or an LLC. If it's an active business, so like a corporation has its own taxes it's paying. So it's gonna pay taxes and then the money. It's kind of like investing in Amazon stock. There's no UBIT if your retirement account invests in it because it's a corporation. It's a C corporation. If it's a pass-through entity like an LLC, an active business, you're going to pay UBIT taxes on any type of retirement account that's investing in that.
Okay. So it depends on the type of the business.
Yeah, whether it's pass through or whether it has its own tax return.
Okay. Fees associated with EQRP.
Setup and everything is $3,500, and then it's $400 a year.
Okay. Does a 401k admin have to comply with the withdrawal request, or can they refuse?
So that if we're talking about the disbursements of the administrator, if the plan is written so that you can have disbursements because of the CARES Act, then they would have to do it. It's up to them whether they're going to put that amendment or that change to their plan. So if they don't put it in, you don't have the ability to do a disbursement.
So, Damion, I actually have a question on the follow-up. So normally all employee plans allow for 50K to be taken as a loan, I believe, up to 50K. So couldn't they actually get at least up to 50K and not pay it until 2023?
So it depends if they have the loan provision. That's another checkbox. Can they do it? And so if the loan provision's in there, then they'd be able to take the loan, and the loan's up to 100. So that is, I mean, that's the change. And it wouldn't make any sense for a plan to say, we're not going to change it from 50 to 100 for the loan. That didn't make any sense if they already have the loan. So it would be good if you have a plan that you're trying to get money out of, ask the administrator if the plan's been updated with the CARES Act. I mean, that's the only way to figure it out.
Okay, so answer is ask your administrator.
Yeah, exactly.
So Hassan asks, this is an interesting question. Is there a deadline to pay your kid $12,000 per year for last year, like 2019? Can I still pay them right now and issue 1099 in the 2019 to be accounted for in the 2019 tax filing?
I'm not an accountant, so if there's a way to do it, your accountant would know. There's a lot of ways to do things retroactively. I just don't know if you have the ability to do, like, you can do a payroll from January and April if you wanted to. Doing it in the previous year, like you can set up a retirement plan going forward for the previous year. Like if you're in 2021, you can set up a plan for 2019, for 2020. So you can go backwards. But in terms of payroll, definitely check with your accountant on any ways to do that. I simply don't know.
Yeah, I know I paid like in December. I paid my daughter in December, but I think I had until April 15th of this year to set up her retirement account. But I think all the April deadlines, as far as I know, have been pushed to July 15th right now.
And there's a way, if you had income from 2019 that you actually want to end up using to defer, and you want it into a retirement account, there's ways to do that. I mean, so we can do it retroactively there's some other plans that we're going to have to set up, but there's definitely an option to do it.
So Hassan, join us for a call next week, most likely next week, with our CPA, and you can ask him that question.
Good idea.
UBIT applies to traditional IRA, but not for Roth IRA, correct?
No, it applies to and UBIT applies to every retirement account for active business and every IRA for any type of leveraged investment.
So even though the Roth IRA is actually not subject to taxes, it can still be subject to UBIT?
It's not still, it can be, it is. It's a lot of, I have an example of some people that are clients, and they had a Roth IRA, and they flipped a house in it. And so their gain was $58,000, and there was a lot of leverage. There was a lot of debt. And before they closed, their accountant said, you're going to have UBIT tax. And so they said, okay, well, what do we do? They converted that IRA into an EQRP. And so they avoided the $20,000 in tax. Here's the downside. If you have a Roth IRA, you can't move the money to an EQRP. You can't move it to a 401k or anything. A Roth IRA is stuck. So that's why you don't, like, a Roth IRA it's unfortunate because you think you're not paying taxes because it's tax-free, except for UBIT, you're going to get taxed.
Wow, I didn't know that. Okay, good to know. I think we already answered that. If you're renting out a unit, it does not qualify as a EQRP business for EQRP unless you're doing the property management and maybe having some income from there. I have a business where I run a 401k. Can I still do an EQRP for myself?
You have a business with what?
Where I run a 401k.
You run a 401k. You can run anything you want, 401k or anything else. As long as you have some other business, you can have an EQRP for that other business.
Okay.
And remember, the business could be a lemonade stand. It's anything. It's the code. If you look at the IRS code, it says for business owners. anything almost under the sun is a business if it has the potential for making profit.
Okay. So Chris asked two questions here. I thought I could only take a distribution of 100K for myself and 100K for my wife. That is still true. There's just 100K distribution for each, but there is a 100K loan for each one of you as well, in addition to the 100K distribution.
That's right.
Yeah. So I have many different IRA accounts. Can I take 100K from each account? I don't think so. I think the limit is 100K disbursement per person and 100K disbursement per loan for each person.
It's an aggregate number. So meaning doesn't matter how many plans you have, you can only do a total of the 100,000 disbursement and total of 100,000 for as a loan if your plans have that option.
Okay. So this is an interesting question. Isn't eqrp allowed for people who are on an H-1B visa? I guess no, as they're not allowed to do any business. I don't know if that's true. I think you can still set up an online business on a visa. I'm not really sure.
So basically, if you have the ability to have income somehow, then you could have one. Yeah, H-1B, it's a good question. And there are different rules for what you can and can't do. So I don't know that there's a blanket answer. It's something you definitely want to check with the immigration attorney or whoever you're working with to make sure you're not violating some rules because you have a business. If you could have an online business and it was based in the US, then it would definitely be an eligible business. The question is that going to violate the H-1B?
Right. Would an Airbnb qualify?
Again, it comes back. It doesn't matter what real estate is. If any type of real estate you have, if you're actively doing something and investing, and if you're actively running the asset management, property management, and you're getting some type of income from it, if it's a passive investment, it's not going to work. If there's some type of active component, especially if you're paying yourself, $100 a month, $200,000 a month or something for doing the work, then absolutely that's going to be qualified.
Yeah, there are lots of questions on the same thing. Like, I have an Airbnb, I have a rental, same theme. Mm-hmm. So in all cases, whatever Damion said, active income, you can qualify.
Yeah, it's called a recharacterization of income. So when you go to your accountant, they're probably going to look at you a little crazy until they realize what you're doing, because what you're doing is you're taking passive income, Schedule E income, and you're moving it to Schedule C potentially, which triggers self-employment tax. And they're going to say, why would you want to pay 15%? And it's so that you're eligible with the business so that you can do other things and roll funds over and be eligible for an eqrp. That's why you're doing it. It's not because you hate your money and want to pay taxes. It's so that you have that actual income from your business.
Okay, this is an interesting question. MJ asks, can I use the money in a Roth or eqrp to buy a high cash value life insurance policy?
You can.
Okay, that was quick. I have more questions. That was a quick answer. Please repeat cost again. MJ, I'm not sure what you're asking. Please ask again. I have set up a series LLC for multiple rental properties. Is this deemed an active business? This is the same question again. It doesn't matter what kind of LLC series, otherwise LLC, as long as you don't pay yourself as an active, like a property manager or something, it's not an active income business. How do you roll over secured and unsecured notes from old self-directed IRA to a new solo 401k? Any 1099 are involved for the notes rollover?
So when you roll over an IRA, any asset from an IRA, it's literally taking the IRA custodian and they're moving it to the trustee of your new plan. So you're simply moving it over and then you send a letter to change the titling to whoever's running the notes. If you've got a note, it's kind of like a good example. If Bank of America has a mortgage and you're paying them, they sell that mortgage to Chase. Chase is they're getting the title is going into Chase's name. That's all that's happening. And then Chase sends you a letter and says, pay us now. Same thing here. It's a retitling of assets after you've done the rollover of the asset from the IRA into your eqrp or solo, whatever you're doing.
Okay. Oh, more questions. It's just coming. All right. Let's see. I have been told that investments which trigger K1 can cause UBIT or UBTI.
Yeah. I mean, if you're doing an IRA, if you have an IRA that's investing and there's a K1 with net income of over $1,000, it's going to trigger UBIT if there's leverage. If you got an active business, it's any income that's over $1,000 is going to trigger it. So yeah, I mean, the answer is yes. A K1 is definitely going to, like, if it has over $1,000 in net income, you're going to have an event.
Okay. If you take a passive share in an active through an LLC, if you take a passive share in an active pass-through LLC business, does UBTI apply?
Wait, is it an active or a passive? If it,
No,
I'm a
I'm
little.
really confused. So you have a passive share in an active pass-through LLC business. So you, as a person, have a passive investment or a passive share of an active business.
If it's you personally, UBIT has nothing to do with that. It's only if an IRA or a retirement account of some sort has the ownership. So UBIT's only really triggering things like trusts and retirement accounts for active businesses. So you personally, it's not an event.
So let's say, no, I think what he means or she means is that, so let's say their retirement account has a passive share in this active income business. Does UBTI apply to them?
Yeah, it applies for anything that's not if it's not a corporation, if it's a passive entity that passes through, then you're going to have a UBIT event.
Okay. How long would I need to keep eqrp? If I disperse 200K from eqrp to Roth eqrp and then withdraw the dollars, wouldn't the eqrp need to be closed then?
You could absolutely close it if you wanted to, just to do that whole strategy.
How do you set up to pay yourself for renting? Again, a tax question, probably more a CPA question. You can do it as a 1099. You can do it different ways. So we won't get that today. Please ask this to the tax guy next week. I'm trying to read all this. There are lengthy questions. I have money in my 401k from my company. My wife runs a business. We file tax together. Can we still take out money from my 401k as per CARES Act, even though I do not run the business? So he's employed. Okay, I got it. He's employed. His wife has a business. They file taxes jointly. And he wants to know if he can take the money out from his 401k as per the CARES Act. I think the question is whether his employer allows him to take it out, right?
Exactly. Yeah.
Okay. My business tax is filed soon, March 15th, and I did not know I could pay my kids before tax. Can I still do that now, or is it too late?
Check with the accountant and see if you have an option, if there's a way to do it to pay your kids.
Probably an accountant question for next week. Vilva asks, I'm on H1B. Yeah. My wife is an H4 plus EAD. Yeah, something to check with your immigration attorney. So we probably can't answer that question here. Cost of setting up a EQRP.
The cost is $3,500 and it's $400 a year, and that covers everything setup wise. It covers your filings with the state and federal, and that covers your ongoing filings and plan compliance, all that kind of stuff. So it's all encompassing everything that you need.
Okay. Last question, I think, unless there's some more which pop up. Amy asks, is there a minimum amount to contribute each year to EQRP? Because that's me with the 6, 9, and a 10-year-old. 3 kids, 6, 9, and 10-year-old.
There's no minimum. There's just a maximum on how much you can put in. So you could literally put in $1,000 or nothing. It's flexible. It's different than like a defined benefit plan, which is a pension plan where you have to put money in. You know, that's how they're structured. Defined contribution plans are absolutely eligible to put in whatever you choose to. It's up to you.
Okay. I think we've gotten through all. Okay, one more. Okay. Oh, 2 more, never mind. I invested 50K in multifamily we are way over the time, but thank you for being here, Damion, and patiently getting through all these questions. I really appreciate your time. I invest 50K in multifamily as a pass-through investment. Are we going to pay UBIT when the multifamily is sold? Depends on what kind of an account it's invested from, right?
Yeah, if it's an IRA that invested, that for almost certainly there's debt involved, and yes, you will be paying UBIT unless you convert it over to an EQRP and you're going to be exempt. So if you're in an IRA, it's a no-brainer. Like it's that $12,000 that you're going to pay on a $50,000 profit. I mean, that makes, what's the return? You set up an EQRP and you save $12,000. It's just so automatic. It's not even funny.
Okay. Yeah, I actually rolled mine over. So I did that before it was sold because I anticipated it selling. So yes, you can still roll it over.
Yeah.
Chris asks about that EQRP being closed. Is this, could this all be done within a year's time period? You know, opening the EQRP, then rolling it over to a Roth, and then closing everything out after you
Yep.
withdraw. I don't see why
Yep.
not.
It could absolutely be done in a year. It wouldn't even take that long, but you could do it all the same year.
Yeah. So I think this is an again repeat question, but we'll take it. I own stocks as an LP and get K1 for taxes. Does it qualify as a business entity? No, it's a passive income. So
Yeah, and definitely check with your accountant
yeah.
on that because that's not my area of expertise.
Yeah, I think Subhani, generally it's very easy to qualify as a business entity to set up QRP. Even if you don't have a business, I think
Yeah.
Damion can help you set something up to actually open the account. So that shouldn't be an issue. You shouldn't have to worry about qualifying as a business entity.
Absolutely. It's not a question of whether you qualify because there's a million ways to qualify. It's just a question of whether it makes sense economically for you to do this. And if you're investing in real estate, it's a no-brainer, and it's something that might most likely will go away at some point. These type of things, because Congress is looking for ways to get more revenue, more money, and so they're gonna look at this and say, oh, the rich people are doing this. So I mean, like Mitt Romney has $100 million in his retirement account. You know, there's a lot of wealthy people that are using this, and at some point it's likely to be pulled. So use it while you can.
Okay. And I think one of the folks who asked about the multifamily investment said it was an IRA club account. So yes, you will have to pay UBIT if it's sold. So it's better probably for you to roll that over before it's sold so you can avoid UBIT.
Yeah, 100% roll it over sooner than later. We're seeing a lot of properties that are actually selling earlier because there's been a lot of interest in them. So you don't want to get caught where you go, oh darn, it's sold, and then you have this big tax bill. It's not worth it. You know it's coming.
Right. So Shankar asks, if I pay 12,200 for my two kids, then 24,400 can be deducted from my taxable income.
That's
They
right.
will not be employees, I guess, because we have a solo 401k which states that our business cannot have employees. Yeah.
Yeah, so we'd have a plan for kids, and that's the beauty of the EQRP, which is it's not a solo 401k. It's set up for, it's dynamic, it's flexible, and so we make sure that you can do these strategies. It's what part of the unique factor. So again, another 12,200. You know, if you're in the 20% tax bracket, 12,200. I mean, you're saving $2,400 on each kid each year in taxes, plus Social Security, which could be another 15% on that 12,200. That's another 2,000. So we're talking potentially $4,000 a year per kid in tax savings by doing this strategy.
Makes sense. Okay, Chris asks, for me and my wife, two QRPs, one for two QRPs, EQRPs needs to be created or just one?
The question is for spouses.
Mm-hmm.
So if you set one up, then we don't charge for the setup for a second spouse.
So you'll just set one up. It's the same cost whether it's for one or two if they're spouses.
Yeah.
Is EQRP good for a college kid?
I think it's good for anybody, especially if a college kid is structuring it as a Roth. So the Roth is something that's very valuable to use no matter what, because it's tax-free forever. And so I think it's I mean, I don't know I can't imagine Roth accounts will last forever.
Okay. I'm still getting questions, so I'm just going to be mindful of time. We're going to wrap this up in a minute here. It's almost 9 o'clock Central Time. So let's take one last question here. For rolling over secured notes from an IRA to an EQRP, any 1099-R to be filed? I think so.
If you're doing a rollover off there, you're not likely to have a 1099-R for the distribution, and then it's not a taxable event. It's just going to show that the money left the IRA or whatever account it was in. So you're likely to get a 1099-R. It doesn't make any difference though, because it's not a taxable event.
Okay. So Shankar asks, just so you get a chance, Damion, to talk about what services you provide or you're offering. So Damion has great answers for everything. Can you please remind me what exact services he offers today?
So we set up the eqrp. We provide the compliance for the different filings when you're doing investments, making sure that you're investing, filling out your forms, your W-9s, and 1099s that have to come in that you have to fill out. Anything that involves your retirement account, we're gonna be there to support it. We're gonna make sure your plan's in compliance. When you have year-end requirements for valuations, we're gonna help with those. Anytime you have a self-directed account, you have to have year-end valuations. We do have a lot of those valuations that we do complimentary, and basically anything to do with compliance, we're gonna make sure gets taken care of so you can focus on your investing.
Perfect. Thank you so much, Damion. I really want to appreciate you and for hanging in there. And I know there was a lot of questions. I just felt
You guys are
like
awesome.
stopping, which is awesome because, people are here to learn. And I think questions are a great way to, to learn for everyone. So
Yeah.
thank you so much again for being here today. I appreciate your time and your effort and your patience, more importantly. And if you have any questions, that's the way to text Damion and to get hold of him and understand how you can set up, whether it's a business entity, a eqrp plan. Based on that, he'll help you through all of it. I have sent a lot of my investors to Damion, so he's really taken good care of them. So thank you for that.
I appreciate that.
Thank you.
And to get, when you send it, if you grab your phone and text the word QRP to 72,000, you're going to get it's about a 15, 16 page report on the essence of the eqrp and what you can do with it, the different pieces, talking about the IRA versus the eqrp. I highly recommend doing this. And then if you want a physical copy of the QRP book, you can go ahead and get one of those too. Just reply back and say, I'd like a physical book. But this will get you more clarity because we went through a lot of information and a lot of those questions are answered in that report.
Perfect. Thank you. And thanks everyone for joining in. I know we went way over our 1 hour webinar time. So thank you so much for joining in and I hope this was useful. I know I learned a lot today, so I hope you learned a lot too. Thank you again, Damion, for being here.
Thank you guys. Thank you, Kavitha.
Have a good evening, everyone.